76% of Americans live paycheck to paycheck. And according to Forbes, 93% of business owners pay more than legally required to pay in income tax. And nearly 50% of all Americans have bad credit, but not you. At least not anymore. See, this is the School of Wealth, where you learn how to maximize your credit, minimize your taxes, and multiply your assets so you can create generational wealth. Hi, I'm Rondy Lambert, certified FICO credit professional, author, speaker, and tax strategist. For the last 20 years, I've helped tens of thousands of Americans just like you take control of their money, fix their credit, wipe out their debt, cut their taxes by 50%, and multiply their assets. If you're ready to break free from the rat race and start building a life of freedom and abundance, then you're in the right place. Welcome to the School of Wealth. Hello and welcome to the show. I'm your host, Rondy Lambert, certified FICO credit professional, author, speaker, and tax strategist. It is so good to be here with you today. I want to spend the next hour or so. I'm going to try to get it done in an hour if I can. I might have to do multiple episodes to get it all done, but in the next hour or so, I'm going to go over the 5 things that make up your credit score, specifically your FICO credit score. Now, there are lots of different credit scores out there. There's FICO, there's Vantage, there's TransRisk, there's Paydex, there's Intella, on and on and on. In fact, there are thousands of credit bureaus out there, and I bet you only thought there were 3, Experian, Equifax, and TransUnion. But there's actually thousands. In fact, if you live in Texas, there's not even Equifax there. There's Inverness. If you live in Mississippi, there's actually a credit bureau of Mississippi. There used to be hundreds of thousands of credit bureaus out there. And as time has gone on, the credit bureaus have started merged together, if you will. The big boys have started buying out the small boys, if you will. And so that's why we really have big 3 that you know about. And I'll do a different episode on the history of credit bureaus. But today I wanted to go over the history of FICO and why FICO and how your FICO credit score is created. Now, FICO was created in 1956 by a mathematician and an engineer, Bill Fair and Earl Isaac. And what they did in 1956 is they created a very complicated algorithm. Not only was it complicated, it was extremely accurate. In fact, since 1956, it has generated hundreds of billions of credit scores. And these credit scores are very special. And the reason why they're special is they predict the future. That's right. FICO, the Fair Isaac Company, also known as the Fair Isaac Corporation, has predicted the future hundreds of billions of times accurately. Now, they are trusted by over 90% of the banks throughout the world. They are the most trusted. They're the Rolls Royce, if you will, of credit scores. Now, soon, Vantage, which has been around not as long as FICO, but Vantage just released just this week, Vantage Model 5. Now, FICO just released a few years ago, Model 10T. T stands for trending. But Vantage, why I brought up the Vantage, is if you are going to be buying a mortgage or buying a house rather and getting a mortgage, you will start seeing Vantage credit scores on credit reports. Now, FICO, the US government, and Vantage have been in a long drawn-out lawsuit for over a decade. FICO lost. And so one of the settlements was that the government would start allowing credit bureaus to use Vantage. And why do credit bureaus want to use Vantage? For competition, for one reason. And number 2, because it's a more accurate credit score when it comes to certain things. But FICO didn't want to give that up. They didn't go down fighting. They didn't go down without fighting. And it was supposed to go into effect January 1st, 2025, this new Vantage FICO credit scoring system on mortgage credit reports. But for some reason, they decided to postpone it. And I don't know when it's going to come back. They said right now it's postponed indefinitely, but maybe we'll see it after the end of this year. I don't know. It'll be good for the industry to have something other than just FICO. So let's get into it. Bill Fair and Earl Isaac created the FICO credit scoring system, and they've changed it now many, many times. Like I said, they're on version 10T. T stands for trending. Now, there are over 4,000 different scorecards. Now, the reason I'm bringing in some of this and not just getting right into the meat and potatoes is you really need to understand how the system works. Because one of the things I hear on a regular basis is, I went to the car dealership to pull my credit to buy a car. So they went to the car dealership to buy a car and they pulled their credit, is what I should have said. Listen, I'm from Idaho. I barely got an education. I grew up very poor. I had to fight my way into school. My parents didn't want me to go to school. And that's one of the reasons I left home at 15. Not only was I tired of eating out of the dumpster, I was tired of being beat up, but I really wanted to go to school. And they rarely let me go to school in elementary school, and they very rarely let me go in middle school in 6th, 7th, and 8th grade. So I left home when I was a freshman in 9th grade. And part of that was I really wanted to get an education. My parents taught me that education was dumb. Rich people were evil. Money was the root of all evil. The only way you could get wealthy is to rob people, etc., be a criminal. And so I just wanted out of it. So I'm not the most educated person, not the most intelligent person. There's things that I know very, very well: tax strategies, corporate law, how to fly an airplane, how to do lots of other things. But there are certain words, just so you know, I have what's called a tied tongue. And what that just means is my tongue doesn't work as well as some other people. I was supposed to get surgery to cut it so I could say certain words, and I never did it. I didn't want to mess with it. It works good enough. My good friend and mentor, Joel Bauer, says, you're good enough. You're good enough. You don't have to be perfect. So I'm definitely not perfect. So there are, back to FICO now, there's 4,000 different scorecards. And why this matters is, depending on what scorecard you're in, could determine what your credit score actually is, or what it maxes out at, or what it could drop down to. So when people come to me and they say, hey, I went to the car dealership to buy a car, and they pulled my credit 50 times, and my credit score dropped 200 points, I don't believe them. And when I say don't believe them, it's because it's not accurate. Now, maybe the score that they're looking at the car dealership is different than the credit score they were looking at online. See, the car dealership credit score is generally a beacon. It's in the beacon model. So model 5, where the score you look at online, if it's a free site, it's not even a FICO credit score, it's a Vantage credit score. See, the Vantage credit score, again, it's the competitor to FICO. The only place you will see a FICO credit score is at myfico.com, and a couple credit monitoring services that you pay extra to have a FICO credit score created instead of a Vantage credit score. Because remember, Vantage is much, much less expensive to buy. See, there's no such thing as a free credit score. It's not free. Somebody's paying for it. Now, it might not cost you anything, but someone had to pay FICO for it. Someone's having to pay Vantage for it. I'll give you a good example. One of my companies is CreditMojo. So CreditMojo.com is a credit monitoring service. So if you ever need someone to monitor your credit, protect you from identity theft, let you manage your bills, manage your money, etc., learn about credit, how to maximize your credit score, etc., CreditMojo.com is the place to go. Now, with CreditMojo, you can get a subscription there for $39.95. That's a Vantage credit score. But if you want a FICO credit score, it costs me an additional $15, $5 per bureau. There's 3 bureaus. So instead of it being $39.95, I would have to charge you $54.95 to make the same money as the $39, because FICO costs that much more. So when someone says, my credit score dropped 200 points, it's not that their credit score dropped 200 points. What generally happens is they're comparing it to a different score. They're comparing a Vantage credit score like at creditkarma.com or creditmojo.com or any of the other ones to a FICO credit score that the car dealership had. And to add to that confusion, remember I said FICO has 10 different versions. In fact, they actually have more than that because it's now 10T. So that's 11 different versions. And then inside those different versions are scorecards. Now, what is a scorecard? Think about it like this. When you were going to high school or college, we had what was called a bell curve. And the way the bell curve works is the teacher would disqualify the lowest grades and disqualify the highest grades and only count the people in the middle, the average, the median. That's the scorecard, if you will. So what FICO figured out was there are certain types of people based on their credit report they figured out that just because you all live in the same area, you all have the same job, you're all the same age, you all have the same education, that doesn't mean that you're going to have the same credit score. See, when I said earlier that FICO has predicted the future accurately hundreds of billions of times, I mean, they predicted the future, and the future, what they're predicting. This is what the entire FICO score system is. Your FICO score. It's whether or not you will have a major derogatory hit your credit over the next 2 years. That is all your FICO credit score is whether or not you will have a major derogatory on your credit over the next 2 years. Now, what does that mean? Whether or not you're going to be late, whether or not you're going to have a 90-day late, a collection, a charge-off, a repo, or a bankruptcy, what they call a major derogatory, hit your credit over the next 2 years. I forgot to hit that one. Sorry about that, guys. Got it turned off. And my phone didn't turn off. There we go. So that's all your credit score is what's the likelihood of you missing a payment over the next 2 years? That's the simplest way to say it. And that's what that number is, 300 to 850. Now, any guess of how they came up with 300 to 850 back in 2013, not 20 years ago, now 50, 70 years ago? How did Bill Fair, Earl Isaac, how did they come up with the FICO score range 300 to 850? Here's how they did it. They just made it up. They just made up the number. There's a little bit of science behind it, a little bit of math. Now, this is not accurate. It's not 100% accurate. I learned this from doing my training at FICO. I was taught this by FICO, but it's not an exact science. But here it is. Your FICO score, 300 to 850, is a direct or a prediction, rather, of whether or not you're going to pay your bills on time over the next 2 years. I've said that. I've said it multiple times. I want you to really hear that because you've probably never heard that before. All of these talking heads and these gurus on social media, most of them don't know what they're talking about. They're just regurgitating information. And I hope on this show, you're going to learn a lot about credit scores and taxes and debt and factual information, not just regurgitated information from some real estate agent or mortgage broker or your cousin Daryl. So that 300 to 850, think about it like this. It's a representation of whether or not you're going to pay your bills on time over the next 2 years. So if you have a 300 credit score, that basically means there's a 30% chance you will pay your bills on time over the next 2 years. If you had an 850 credit score, then there's a 85% chance you'll pay your bills on time over the next 2 years. That's it, guys. It's not any more complicated than that. Now, yes, it actually is much more complicated than that, but that's the the layman's way of understanding the score. So now I want you to, if you don't have credit monitoring, go to CreditMojo.com. It's CreditMojo.com. It's going to cost you $1 to sign up for a free trial for a week. And then after a week, if you don't cancel, it's going to be $25 a month. CreditMojo.com. If you need credit repair, then go to CreditMojo.ai.com. Two different sites. CreditMojo.com is just strictly credit monitoring. CreditMojo.ai brings in the credit repair software so you can fix your credit. Don't have to know anything about it. Our software, it automatically, over the last 20 years, almost 20 years now, I've kept track of every single letter I've ever sent, every single response we've ever gotten from the credit bureau, trained an AI bot to create credit repair letters for you. So you don't need to know anything about credit repair. You just log in, put in your username and password, it automatically brings in your credit report. You select the items that you want to dispute and have removed from your credit report. You hit save, you print them, sign them, put them in an envelope, and mail them off. That's it. That's simple. So for less than $50 a month, because CreditMojo AI is either $39.95 or $49. And if you do the $49 option, you get training with me, and I show you how you can send a credit repair dispute letter for 2 pennies, not your typical 57, 59-cent stamp, whatever it is right now. 2 pennies, a 2-cent stamp. You can actually use that 2-cent stamp on anything. I'll teach you a little hack on how our postal service works. So back to the credit score. So when you look at it, it's that range, 300 to 850. So if you don't have credit monitoring, go to CreditMojo.com and figure out where your credit score is. If you know what your credit score is, let's say you're a 650, then there's a 65% likelihood you'll pay your bills on time. You got a 740, there's a 74% likelihood you'll pay your bills on time. Got 800, there's an 80% chance you'll pay your bills on time. See how that works? Now, that's not exact science, but it's close enough that it'll help you remember if you have good credit or bad credit. Because people ask me all the time, what's a good credit score? Well, it depends. It depends on what you want. If you're trying to get a mortgage, you need to have a 580. If you're trying to get a stated income mortgage, so if you're trying to get an agricultural loan or FHA loan, little money down, low risk in certain areas, 580. If you're trying to do a stated income loan, and that is you tell the bank how much money you make. And yes, these exist. We do them all the time here at Fortress, at my company. You need at least 760 credit score or 76, right? 76% likelihood you'll pay your bills on time. And with a 760 credit score and 30% down, you can buy any home that you would qualify for with no financials, just your bank statements. That's it. And a letter from your CPA stating that it is your bank statements that you gave us and that, yes, you did make X amount of money gross. See, they look at the gross revenue of your business, not your net income of your business. So if you're a business owner, you want to buy a $3 million house, but can't qualify for it because you've structured your business in a way that you don't make a lot of money, so you don't have to pay the taxes, I got you. I can help you out on that. So if you have a 760 credit score, 76% likelihood you'll pay your bills. That's all that number means. Now, there are 5 things that FICO wants to see in order to calculate your credit score. Or I should say there's 5 areas that FICO's looking at. These podcasts are a little different for me when there's nobody here. And it's just me flapping my lips, but I still have a good time. So I hope you're getting a lot out of this. So there are 5 areas that FICO's looking at. Number 1, and this is what everybody else looks at. This is what all of the talking heads on social media talk about. It's payment history, payment history, payment history. And this is what people focus on when they would call our office to get their credit fixed. They were like, yeah, I got these late payments I need removed, or I got a collection, or I got a bankruptcy. They focus on the 35%. Now, I'm a pilot. I spent 15 years in the National Guard on a medevac helicopter. And then after I got out of the military, I got my private pilot's license. I have my own plane. Generally, when I travel in my own plane. So I don't have to deal with all of the nonsense you got to deal with at the airport. Now, if it's over 1,000 miles, like next week, I'm flying to Houston, I'll fly commercial. But if I was going to be flying to Salt Lake, I live in Boise, or if I was going to go to Las Vegas, I just fly my own plane because it's faster, it's cheaper, and it's easier. Put my dog in there, put my guns in there, put in my girlfriend, and anything else I want. I got room for 4 more people. So as a pilot, one of the first things they teach you is don't get tunnel vision. Just constantly scan. You're scanning your instruments. You're looking at everything. Don't just focus on one instrument. You know what happens when you focus on one instrument and you're in a helicopter? You fly into an airplane and you kill everybody. That's what happens when you get hyper-focused or tunnel vision. I ride motorcycles. One of the things that they taught me in the advanced motorcycle school is you look where you want to go, not at what you don't want to hit. Because if you look at what you don't want to hit, you're going to hit it. I've been told, same thing in racing school. You look where you want to go, you don't look at the wall. Because if you look at the wall, next thing you know, you hit the wall. So when a lot of people, they will call us and they're like, I got this collection, and they're focused, they got tunnel vision on the negative payment history. That, my friend, is less than 20% of your credit score. Your negative payment history is 110 points. That's it. It's 20% of your score. And they focus on the 20% and ignore the 80%. And this is why most people that have poor credit is because they're focusing on the 20. Think about it in the gym world or an exercise world and healthy world. Imagine if you focused on just going to the gym and you ignore what you eat, what you put in your mouth. You can't outrun your mouth. If you eat nothing but garbage, but you work out 7 days a week and you hammer down on that treadmill or on that spin bike and you lift and you crush those weights, but you eat just garbage, you are not going to have the body, the physique that you want. You got to focus on the 80% plus the 20%. So we focus on all of it. So the first thing is payment history. That represents 35% of your credit score. That's the first of the 5 areas that FICO is looking at. Now, I said 35%. You might be thinking, wait a minute. If you were paying attention, earlier I told you 20%. That's right. 20% of your score is the negative payment history. 35% of your credit score is the payment history. That's negative and positive. So 35% of your credit score is payment history. Then you have amounts owed. That's 30% of your credit score. This is not debt to income ratio. I hear this all the time. In fact, I was just on a podcast, someone else's podcast, and the guy said, the guest, he's like, and he's from Brazil. So not that that matters because people from America still say this. They will say stuff like, my debt to income ratio is really high, therefore I have bad credit or I have a poor credit score. No, your income does not come into play when FICO creates your credit score. Neither does your sex. Whether you're male or female, doesn't matter. Whether you're black, white, brown, yellow, purple, does not matter. Whether you have hair or no hair like me, whether you have a beard or no beard, whether you're short or tall, skinny or fat, young or old, it doesn't matter. FICO doesn't care. They don't care if you're Christian or Muslim. They don't care where you live. They don't look at any of that in that data. It's called empirical data. They don't look at any of it. What they look at is what's on your credit report. your payment history, the amounts you owed, new credit, length of credit, and credit mix. And I'm going to get into the rest of them. So when someone says my debt to income ratio is too high, that's why I have bad credit. It's not accurate because they don't look at your income. What that does pertain to is how much money you owe. And here's a secret. FICO doesn't care how much money you owe on a car, a motorcycle, an airplane, or a mortgage. They don't care much. They care a little bit. A little bit. I'll give you an example. If you are a veteran like I am, you can go in and you can buy a house with no money down. The house that I live in, I purchased it in August 2021, and I put down $550. That's it. $550. I wrote the earnest money check for whatever it was. I think it was $30,000 at the time. I went to closing. They gave me a refund of the earnest money check and charged me, and they kept $550 to pay for the inspection. That's all I paid, $550. So when you're a veteran, you can buy a house with no money down. If you are not a veteran, you can buy a house. If you haven't purchased a home in the last 5 years, then you qualify as first-time home buyer. Even if you bought a home before, as long as you haven't owned a home in the last 5 years, you can qualify for first-time home buyer again, and you can put down 3.5% through FHA. Now, if you don't want to do FHA and pay all the extra taxes and all of that, not the taxes, the extra fees, the private mortgage insurance, then you put generally down 20 to 25%. 20% for the down payment, 3 to 5% for the closing costs. Okay. Back to the 30% owed. When I bought my house, I put $550 down. The mortgage showed up on my credit report a month later. My credit score went up about 25 points. That's about all you're going to get when you buy a house, about 25 points, somewhere in there. Okay, depends on your scorecard again, because back to the scorecard. There's lots of different scorecards, and I'll get into scorecards a little later. So 30% is how much you owe, but they almost always ignore mortgages and car loans and student loans and other types of loans. They really only care about one thing: lines of credit, also known as a credit card. See, a credit card is a line of credit. It's just a card. It's the same thing as if you just went to the bank and got a line of credit with a checkbook or debit card. Not to be confused with a home equity line of credit. That's different. So a credit card's a line of credit. When FICO creates that credit score, they're looking at how much money you owe on your line of credit or your credit cards. This is a big thing here. This is the most impactful thing on your credit score is credit cards. So it's 30% of your credit score basically has to do with how much money you owe on a credit card. Now, if you go back to the 35% with payment history, it's payment history on the credit cards. Now we're at 65% on just credit cards. So that's two areas. Now let's get into the third area, and that's new credit. This is where people get really confused. They think that inquiries are new credit, the 10% of the credit score. Now, if you figured out 10% of your credit score is new credit, and you went to the car dealership and they pulled your credit 50 times and you dropped 200 points, that is impossible. Here's why. Because there's only 55 points even associated with new credit. 55, 5, 5. How did I come up with 55 points? Well, it's 10% of your credit score. If your credit score is 850, wouldn't that be 85 points? No, it would not. Here's why. Because your credit score is 300 to 850. So you need to subtract 300 points from 850. So if you subtract 300 from 850, you're left with 550 points. That's how many points you have. 550 points. So when you do 10% of 550, it's 55 points. When you do 30% of 550, it's 165 points. Guess what happens when you max out all of your credit cards? You lose 165 points. See how that all ties together? Your credit cards, how you manage the credit cards, how many credit cards you have, how much you spend on the credit cards, when you pay off your credit cards. That's the most important thing when it comes to your credit score. It's the most impactful thing. So 10% of your credit score is new credit, not just inquiries. It's, do you have new credit or do you not have new credit? What is classified as new credit? Anything that's been open in the last 24 months. So anything that's been open the last 24 months. So that's 55% of your score. So if you go out and you go into a car dealership and they pull your credit 50 times, that only counts as one inquiry, by the way. One inquiry, because under the FICO rules, if you go and have your credit pulled for the same reason in a 45-day window, counts as one inquiry. Even if you go to different car dealerships, counts as one inquiry. That's it. So if it's 100 inquiries or 200 inquiries or 300 inquiries, all within a 45-day window, it's one inquiry. So it's 55 points total, including the new credit. So how does that work? Well, FICO has figured something out. Remember I told you, they have predicted the future accurately, hundreds of billions of times over the last almost 70 years. What they figured out was 90%, 90% of all late payments that ever hit a credit report, 90% of it happens in the first 2 years. Let that sink in. 90% of all late payments that ever hit a credit report happen in the first 2 years of the account being open. And the reason why your score drops so much after getting a new car or a new credit card is because the likelihood of you being late is so much higher now because you have new credit. And so what they'll do is they'll artificially lower your credit score to see if you're going to make payments. And then as you start making payments on that new loan, your score will come back up. But that's 55 points. So if you're the kind of person that's constantly getting a new car every 2 years, always getting new credit cards every 2 years, applying for new credit all the time, you, my friend, will never have great credit because you're just churning it all the time. I have a friend, his name's Brad Lee. You might have heard of him. Does a little podcast called Dropping Bombs. When I first met Brad, he had a very poor credit score. And I'm not sharing any confidential information about Brad right now because I am the guy in the book that he wrote, and he talks about how he had poor credit score. He was a victim of identity theft. And then he also was a victim of liking cars. And he would go buy a new car. I mean, after all, he was from the car world. Every 6 months or so, he'd go buy a new car. And then when he'd get these credit card offers, 0% interest, he would close his old credit card and get the new credit card. And he was always doing this churning. And so he had a very low credit score because he just didn't know how to manage it. Now, once I removed the identity theft, which took me less than 72 hours, that he'd paid an attorney over $10,000 and it took years of nothing. In 72 hours, I fixed his identity theft. His score went up, but not great, but good enough that I was able to get him good credit cards. And then he just did what I told him. In over a matter of about 4 years, last time I saw, he posted something on Instagram recently, an 847 credit score, up almost 300 points from when I met him. All because he started managing his credit the way FICO wanted him to manage it. So to recap, 35% of your credit score is payment history. 20% of it is your negative payment history. So we break that down. 15% is positive, 20% is negative. And then 20% of your credits, or then 30% of your credit score then is amounts owed, which is primarily what you owe on your credit cards. If you max out your credit card, whether it's a $500 credit limit, 50,000 or 5 million, you max it out, you're going to lose 165 points. Pay it off, you get the points back. And then 10% is new credit. Anything less than 2 years old. So whatever you do, if you want to have good credit, you want to have great credit, don't open and close accounts before they're at least 2 years old, preferably 4 years old. At 4 years is when you start really seeing the benefit of it. Most people think fixing their credit takes money, time, and endless back and forth. But what if you had AI doing all of the hard work for you? CreditMojo uses a powerful technology based on over 2 decades of proven strategies to find errors on your credit report, create custom one-of-a-kind letters for you, and then guide you through the process of how to mail them to the credit bureaus. You stay in control without doing any of the heavy lifting. Go to CreditMojo.ai/School of Wealth to get started today for only $1. That's right, you can get started today fixing your credit for only $1 at CreditMojo.ai/School of Wealth. Brings me to the fourth section of the FICO credit score, and that is length of credit history. How long have you had credit? And that's 15% of your credit score. 15% of what? Of 550. So what is that? 75 points? Somewhere in there, 72 points, something like that. 15% of your credit score is length of payment history. How long have you had credit? How long have you used your credit? This is why when you turn 18 and you get your first credit card, you're going to have a low credit score. Why? 1, you don't have any payment history. 2, it's new credit. And 3, the length of credit history. You just don't have it. So you as an 18-year-old or 20-year-old, and you get your first credit card, that will give you a credit score, because before you get that first credit card or the first student loan, you have no credit score because there's nothing to calculate. That's why Dave Ramsey's so wrong when it comes to credit. He's right in many other ways, but when it comes to credit, almost every single thing Dave Ramsey says about credit is wrong. He's afraid of credit. On this show, we're not afraid of credit. On this show, you learn how to maximize that credit so you can maximize and multiply your assets. See, it is so much easier to become financially free, to become wealthy, if you use and utilize your credit properly. So much easier. Yes, you can get wealthy, paying cash and bootstrap and everything. It's just a lot harder. It's going to take a lot longer. So if you want to supercharge it and speed it up, maximize your credit. If you just get started, you're going to have a low credit score for a while. It's going to probably be about 4 years until you get up into the 700s. It takes 10 years to hit 800. It takes 20 years of credit history to hit 850. 10 years to hit 800, 20 years to hit 850. Now, side note, if you're a business owner, you can do the equivalent in 3 to 6 months. 3 months, have an 800 FICO through your business. 6 months, have an 850, or the equivalent of, it's called a PAYDEX score, 80 PAYDEX or 85 PAYDEX. But back to personal credit. So 15% is your length of credit history. So you can do it one of 2 ways. You can start out with your own credit, or you can do what's called authorized user accounts, piggybacking. What that is, I'll give you an example. All of my kids, when they graduated high school and they turned 18, all of them had 800 credit scores. My grandson, who will be 14 in October, when he turns 18, so in 4 years, 4.5 years from now, when he turns 18 and I get him his very first credit card, he will have an 800 credit score. Now, you might be thinking, wait a minute, Rondi, you just said it takes 10 years to get 800. It does. It takes 10 years on your own. But if you can have someone add you to their credit card as an authorized user, all of their credit history will then report on your credit report as credit history. So if you're a parent or a grandparent or an aunt or uncle, and you really want to give someone a jump start to building credit so they become wealthy, they can become financially free, add them to your oldest credit cards. Doesn't matter about credit limit. Remember, FICO doesn't care what your credit limits are. They care about how much money you owe. So if you can add someone to the credit card, your credit history will show up on their credit history 30 to 45 days later. In fact, this is one of the services that I offer. I have, over the last now 20 years, fixed hundreds of thousands of people's credit. And over those 20 years, I have people that we fixed their credit, got them credit cards, and now they have a part-time job with me selling their credit card or renting their credit cards. See, one of the things that I teach inside my private coaching, as well as on this show, is how much money you make is not as important as how much money you keep. Let me repeat that. How much money you make is not as important as how much money you keep. What do I mean by that? Well, if you go out and make $1 million and you give half of it to the IRS, 500,000 of it, which is not an exaggeration by any means, and you're left over with 500,000 and you spend it all, you're worse off than someone who makes $50,000 a year and keeps 5,000. How much money you make is not as important as how much money you keep. You need to learn how to keep more of your money. So one of the things I teach is how to keep more of the money. Well, as a W-2 employee, there's not a lot you can do. You have to be a business owner. That's where all of the tax deductions are. That's where all the tax strategies, like 99% of tax strategies, are for business owners. See, W-2 people are what they're called takers. They take from the economy. Business owners and entrepreneurs give to the economy. Therefore, the IRS says, hey, if you give to the economy, if you're a maker versus a taker, you don't have to pay income tax, or you can at least significantly reduce your income tax. So be a maker, not a taker. But what if you're a W-2 employee, like I was when I was a fireman? Then you start a side hustle. And that side hustle could be renting your credit. So I have now 5,000 credit cards that I can rent called authorized users. You can go to rondylambert.com and click on credit, and then you can learn about the credit cards. So how does that help you? Well, if you're just starting out, or you listen to Dave Ramsey and you cut up your credit cards and you lived off the grid and you ate beans and rice and beans and drove a beater and paid cash for everything, you're starting all over. Or you were like me and you filed bankruptcy and it wiped out everything. Now you got to rebuild. Or COVID hit and you lost your business and you defaulted and charged all the credit cards off and lost the house and the cars. That happened to millions of people, unfortunately. Well, the authorized user program will fast forward that to where you could come to me and say, hey, I need a $10,000 credit card that's been open for at least 10 years. In about 72 hours, I can have that $10,000 credit card that had been open for 10 years show up on your credit report. And now you have payment history. You have credit cards that are not maxed out. It's not new credit. And now you have a long credit history. See how all that applies? Which brings me to the last thing, and that is credit mix. That's the last of the 5 things that FICO does or looks at when creating your credit score. Credit mix. What is credit mix? A mixture of your credit. FICO wants to see 5 things on every single credit report in order to have the best FICO scores. You don't have to have all 5 to have a FICO credit score, but if you want to have a 800 or 850, you got to have all 5 things. Here they are. Number 1, and most important. So the number 1 thing and most important thing to have on your credit report at all times is a minimum of 3 credit cards. I'm going to repeat that because I want to make sure you really heard that. The most important thing for you to have on your credit report in order to have the maximum credit score, it's 3 credit cards. I prefer that you would have 4 in this order: American Express, Discover, MasterCard, and Visa. Have one of the 4. Not all Visas, not all Discovers, not all American Express. Have one of each: American Express, a Discover, a MasterCard, and a Visa. But a minimum of 3. That's the first thing of the credit mix, the 10% or 55 points. The next thing they want to see is a installment loan. What's an installment loan? That was a motorcycle loan. Like my daughter just bought a motorcycle over the weekend. She listened to me. She financed it. She could pay cash. But why would you pay cash when interest is only 4% and inflation was at 15? Now, I know inflation is not fixed. It's now come down. Now that Sleepy Joe's out, inflation's kind of neutralized or balanced out, if you will. But again, I like to use debt when you can, if it's a low interest rate. Now, if the loan on that motorcycle is 12, 14%, I said absolutely not. But I think she got it at 3.9%. She can now use that money instead of paying cash for her $5,000 motorcycle. She could now invest it and do a lot better in the stock market than 3.9%. And then just make the payments, because after all, it builds her credit up. Later on, I'll teach you how you can get the loan and pay no interest or very, very little interest. So they want to see an installment loan on your credit. They also want to see a mortgage if possible. So they want to see at least 3 credit cards. They want to see at least 1 installment loan and then a mortgage. Now, do you remember in the beginning when I was talking about the house that I bought in 2021, how many points I got? Do you remember what I said? It's 25 points. That was it. So when I got my mortgage, because I'd already had a house before, I sold it, and then fast forward 2 years, bought a new house, and my score went up 25 points. See, when the mortgage was sold and I closed the previous Lake Tahoe house, my score went down by 25 points. When I got the Idaho house, my score went back up 25 points. It's not the end of the world. See, you can have credit scores in the 800s without a mortgage and without a installment loan, but you will never, ever, ever, ever have an 800 plus credit score without credit cards. It is impossible. Why? Because 80% of your credit score, like I've been telling you for the last now 47 minutes, is credit cards. They are the most important thing. So when Dave Ramsey says, cut up your credit cards, close them, use cash, use the envelope system, use your debit card, it's the absolute worst advice when it comes to credit. Now, listen, if you are a creditaholic and you cannot be trusted with credit and you want to become debt-free so you eventually become financially free, then stop using the credit cards, but don't close them. Please do not close them, because if you close them, it will destroy your credit score, because you're going to start losing the payment history. You're going to lose the amounts owed. You're going to lose the length of credit history, and you're going to lose the mix. And now you end up with bad credit again. And when you have bad credit, you pay more for everything. Did I say everything? Yes, I said everything. Gas, groceries, electricity, your car insurance, your life insurance, your homeowner's insurance, your renter's insurance. Everything costs more if you have poor credit. And here's why. Your insurance company pulls your credit at least twice a year, sometimes once a month, but at least twice a year to check you actually have a insurance credit score. If you sign up at CreditMojo.com for credit monitoring, you can click on different types of scores. There's different scores. There's bankruptcy scores, there's mortgage scores, there's car loan scores, there's credit card scores, there's recreation vehicle scores, and there's insurance scores. There's even life insurance scores, homeowners insurance scores. Why would an insurance company care about what your credit score is? Well, what is your credit score again? Remember, it's the likelihood of you paying your bills on time over the next 2 years. That's all it is. but it's more than that. See, what the insurance companies have figured out is if someone has a poor credit score, they're more likely to have an insurance claim. And therefore, you pay more for car insurance if you have poor credit. You pay more for life insurance if you have poor credit. You pay more for your mortgage, the insurance, the property, the homeowner's insurance. You pay more. Why? Because people with poor credit are more likely to have a claim. Now, some of it, not all of it, some of it's because they're more likely to commit fraud. The other side of it is because they're distracted. They're stressed out. They're sleep deprived. They're struggling financially. I'll give you an example. You got two employees. One is getting harassed constantly by debt collectors, can't pay his bills, fights with his wife, lost his car, got repoed. You got the other employee that's just smooth sailing. His finances are all under control. Credit cards are paid off. Car loans paid off. Mortgage is paid on time. It's got a little bit of money in the bank for savings. Who's the better employee? The guy with good credit. This is why 76% of employers look at credit. Now, they're not supposed to look at scores, but most people don't know the difference. They don't know how to read a credit report without looking at scores. Back to the insurance. You got a driver. One's getting texted constantly, like I was earlier, because I didn't turn off the damn thing on my computer. I turned it off on my phone, forgot on the computer. They're getting texted constantly. They're getting called by collection companies. They're not sleeping at night because they're stressed out. They're fighting with their spouse. They're worried about their job because they're so tired they're not doing a good job. Who's more likely to have a car accident? The person is stressed out, sleep deprived. The person is just enjoying life. The person is stressed out, right? So the insurance companies know this. And so they base how much you pay on your credit score. Now, what about electricity, cell phone, gasoline? How does that apply? Here's how. If you and I pulled up the gas station at the same time, and we both got $20 worth of gasoline. Gas is $4 a gallon. Let's just for easy math for me. Gas is $4 a gallon. You get 20 gallons. I get 20 gallons. $4 a gallon. How much does that cost? $80. Now, if you pay cash, it's $80. You pay check, it's $80. You pay debit card, $80. But I'm not going to use cash, debit, or check. I'm going to pay with a credit card where I get 5% cash back. So now instead of me paying $4 a gallon, I'm paying $3.80 a gallon. I've seen people in lines at Costco that are an hour long to save 10, 15 cents. What about the 20 cents they're throwing away by not having good credit? Now, you might say, well, it's only 20 cents. It's not that big of a deal. It is over a year or a decade or a lifetime. It's a lot of money. What if you're a truck driver and you're spending tens of thousands? Or you're like my friend Ed Milet that spends over $1 million a year on fuel for his jet. And if he paid with a debit card. $1 million at 5% cash back, that's $50,000. Everything costs more, my friend, if you have poor credit. Everything. So if you want to become wealthy, if you want to become financially free, then the first thing you need to start focusing on is maximizing your credit. And that's one of the first things I teach. I teach how to maximize credit, minimize taxes, and multiply assets. So focus on maximizing your personal and your business credit. I'll talk about business credit later on some other episode, but for now, maximize your personal credit. So to recap, you need at least 3 credit cards open at all times. Later on, I'll do an episode on how to manage those credit cards, how to know when to pay them off, how much money you just spend. But just for now, if you don't have at least 3 credit cards, You need to make your mind up that in a while, you're going to learn how to maximize your credit score a little bit more so you can get better credit cards. But you need 3 credit cards. Now, if you have family, friends that could put you on their credit cards, I recommend that you reach out to them. Just say, hey, I'm listening to this crazy bald guy on YouTube, and he says I need 3 credit cards. And if you put me on your credit card, it'd really help me out. They don't have to give you the credit card. In fact, a lot of these banks won't even issue the credit card. So there's nothing you can do. It's kind of like, imagine this. I'm flying to Houston next week. Imagine if you're my Uber driver, because I will be getting an Uber or a shuttle van, whatever. Does my driving record affect the Uber driver's insurance rates? Nope. Am I responsible for the maintenance, the insurance, the gasoline, the loan payments on the Uber car? No, it's totally separate. But am I benefiting from the Uber driver? Yes. Now, if the Uber driver got in an accident, that could hurt me. Whereas if they added you their credit card, they miss a payment, it could hurt you, but that's easy to fix. But generally speaking, if someone puts you on their credit as an authorized user, it doesn't affect them at all. You just get all the benefit. Just like when I get in that Escalade for the Uber, I benefit from the car. I don't have to pay anything outside of what I paid for the Uber ride. Just like with the authorized user, you simply just pay for the authorized user. You don't have to make the payments on the card or the annual fee or any of that. So if you don't have at least 3 credit cards and you have family members that have great credit, go to them. The other thing you should do if you're married or have a significant other partner, put each other on your credit cards as authorized users. Put your kids on your credit cards as authorized users, your grandkids, brothers, sisters, aunts, uncles, whatever. Doesn't cost you anything, doesn't hurt you, doesn't affect your credit score unless you give them a credit card and then they go out and max it out. So don't give them a credit card. It will still report even if there's no physical card issued. So those are the 5 things that FICO's looking at when creating your credit score: payment history, amounts owed, new credit, length of credit, and credit mix. You need at least 3 credit cards on your credit at all times. It's going to take you 10 years to get to 800, 20 years to get 850, unless you do authorized users, and then you can speed that up. Because if you get 3 authorized user accounts that are 20 years old, you now have 20 years of credit history on your credit report. If you need some help with your credit, you can always go to CreditMojo.ai. That's CreditMojo.ai. If you just want credit monitoring, go to CreditMojo.com. If you like the show, please give me a thumbs up and share it with a loved one. Share it on your social media. Appreciate it. And if you're watching this on YouTube, ask your questions, put in some comments. Want to engage with you. All right. Have a good day.